On this slide, we will understand the concept of systematic risk and non-systematic risk. As I'm sure you've realized by now, if you want a high return, you need to take high risk. But does all high risk lead to high returns? The answer is a big no, because not all risk is the same. If we talk about total variance, where variance is a measure of risk, so we are talking here about total risk, it can be broken into two components: systematic risk and non-systematic risk. There is no compensation for non-systematic risk because non-systematic risk is local or specific to a particular security and can be diversified away. Investors get a return for systematic risk. The systematic risk impacts the entire economy or the stock market and cannot be diversified away. So the important point is that investors only get a return for systematic risk. This is also called non-diversifiable risk. Pricing of risk. Pricing an asset is equivalent to establishing its expected rate of return. Therefore, price and return are often used interchangeably. If you recall, earlier in FRA, we talked about fixed income securities or bonds. And we said that as long as we know the cash flow associated with a bond, the price of a bond can be computed using the rate of return or the discount rate. What we are saying here is that the riskiness or the systematic risk determines the rate. The rate really is equivalent to knowing the price, because once we know the rate, we know the price. Therefore, when we say pricing of risk, we are really talking about coming up with the appropriate rate of return given the level of systematic risk. That rate can then be used to compute the actual price of a security. The bottom line is that only systematic risk, which is called beta risk, is priced, and only this risk earns a return. Non-systematic risk can be diversified away and gets no return. It does not earn a compensation. Let's look at some examples. Describe the systematic and non-systematic risk components of the following assets. A 6-month T-bill. With a 6-month T-bill, you know exactly how much you are going to get after 6 months, so there is no risk. The systematic risk is 0 and the non-systematic risk is also 0. The variance, therefore, is 0. An index fund based on the S&P 500 represents the market. With a market portfolio, we only have systematic risk. All the non-systematic risk has been diversified away. Therefore, this entire risk is systematic risk. There is no non-systematic risk in a market portfolio. Consider two assets X and Y. X has total risk of 25%, of which 15% is systematic risk. Asset Y is the S&P index, which we talked about over here. The total risk is 18%. All of this 18% is systematic risk. Which asset will have a higher expected rate of return? There are two ways of looking at this. One way is to say that for asset X, we have a total risk of 25% and we compare this with 18%. The other is to only look at systematic risk and say asset X has a systematic risk of 15 and asset Y has systematic risk of 18. So do we do this comparison and say that asset X has more risk and therefore gets a higher return? Or do we do this comparison and say that asset Y has greater systematic risk and therefore gets higher return? Given what we talked about earlier, only systematic risk is priced. So we need to look at this comparison, the comparison between the systematic risk of the two assets. Given that asset Y has higher systematic risk, we can expect a higher return over here. It would not be sensible to invest in X because A, you are taking higher risk, and B, you are getting a lower return. Now do example 4 from the curriculum. Let's move on to return generating models. Return generating models provide an estimate of the expected return of a security given certain parameters. We can have multi-factor models or single-factor models. If you have a return generating model, the idea is that you give certain inputs called factors, and the output is the expected return of a security. If there is only one input, then we call this a single factor model. If there are multiple inputs, then it is called a multi-factor model. We cover multi-factor models at level 2. In level 1, we focus on single factor models. A classic single factor model is the market model, where the return of a particular security is given by this alpha, which is an intercept term, times beta, which is a measure of systematic risk, return on the market, plus a stock specific or security specific return. We can come up with the market model by running a regression of a given security's returns with the returns on the market. We will get a scatter plot and create a regression line. You don't need to know the details over here. What you do need to know is the interpretation of these terms. Alpha represents the intercept of this line with the y-axis. This is the expected return when there is no change in the market. The beta is the slope of this line, and E represents a stock specific return. If we are given the following data where alpha is 10%, beta is equal to 1.5, let's say that the market return is equal to 10% and E is equal to 2%, then what is Ri? You simply plug and play. Alpha is 10 plus beta is 1.5 times Rm, that gives us 15, plus E is 2. So here we will have 25 plus 2, which is 27. Again, the key point is to recognize that alpha is the intercept, beta is the slope, and we are plotting Ri against return on the market. We've talked about beta. Now let's figure out how we calculate beta and how we interpret beta. Beta is a measure of systematic risk. It tells us how sensitive an asset's return is to the market as a whole. Specifically, beta can be written as the covariance of return on stock I with the market. So we look at the return on a stock relative to the return on the market and see how they vary relative to each other. This is divided by the variance of the market. Symbolically, we can write this as covariance of returns of I with the market divided by variance of the market. This then can be written as correlation between the stock and the market multiplied by the standard deviation of returns of stock I multiplied by standard deviation of returns of the market. Here we have simply taken covariance and expanded covariance into this term, which is divided by the variance of the market. This and this cancel out. So beta is equal to the correlation times the standard deviation of returns of the stock divided by standard deviation of market returns. This expression you need to remember. In case you have trouble remembering this expression, you must remember this interpretation of beta and then derive the relationship. Practically speaking, we calculate the beta for a stock using regression. Let's say that you consider a particular stock and you look at the last 100 months of return data for the stock and the market. You will come up with some sort of a scatter plot where each point represents a given month, and this point would, for example, be the market return and the stock return for a particular month. We then draw a line which is called the best fit line, that is the regression line. The intercept term is an alpha, but we are talking about beta over here. The beta is the slope of the line. Let's do some examples now. Assume the standard deviation of market returns is 20%, so sigma m is 20%. Calculate the beta for the following assets. A 6-month T-bill. The beta here is going to be 0 because there is no correlation between the market and a T-bill. Since there is no correlation, the beta is 0. As we've discussed earlier, you can also think of the 6-month T-bill as an instrument where the return is known, so there is no risk. A commodity with a standard deviation of 15% and 0 correlation with the market. Here the return is not known because we have a standard deviation of returns, but the correlation with the market is 0. If you go back to the formula that we just derived, beta is equal to the correlation between the security and the market times sigma I over sigma m. Since the correlation is 0, beta is going to be 0. And finally, a stock with sigma equal to 25% and correlation of 0.6. Here we need to use the formula. The beta is equal to 0.6 multiplied by sigma I, which is 0.25, divided by sigma of the market, which is 0.20, and this will be 0.75. Now I want you to do example 5 from the curriculum, and it is essential that you learn this relationship. The capital asset pricing model, or CAPM, is one of the most important models in finance. It allows us to compute the expected returns of assets based on systematic risk. If you can think of CAPM as our model, we give this two types of inputs. One type of input is related to the market, which includes the risk-free rate and the market risk premium, which is the difference between the expected market return and risk-free rate. This information is common to all stocks in a given market. In addition, we give the systematic risk of a particular stock, and the CAPM model will then give us the expected return for stock I. In this particular model, the only input that is stock specific is the systematic risk of the stock. This is a single factor model. You need to recognize that a model which is as powerful and as simple as this one, the capital asset pricing model, needs to have several assumptions, and those assumptions are listed right here. You need to read these several times and memorize them. You don't need to get too hung up with the details, but if you want, you can read a couple of paragraphs related to each of these assumptions in the curriculum. I will just say these out for you in order to help you remember. Assumption number 1 is that investors are risk averse, utility maximizing, and rational. We assume frictionless markets, which means there are no transaction costs, a single holding period, homogeneous expectations, which is something we've talked about earlier, where all investors have the same expectation about the return of a particular stock, the risk of a particular stock, and the covariance or correlation between stocks and securities, and so on. Investments are infinitely divisible, and investors are price takers. In other words, we just see a given price of a given asset and we buy or we don't buy. We do not influence the price. Let's do this simple example now. In fact, I want you to do this example before you look at the solution. Here is what you need to do. Note that you need to compute beta first, and we've done this before. The beta is 0.75, and then we use the capital asset pricing model. Simply plug in the numbers given and arrive at the required return. Notice that the required return is less than the market return of 10%, and that is because of the relatively low beta. Beta is less than 1, which means that our return or the expected return is going to be less than the market return. Now I want you to do example 6 from the curriculum. Security market line. The security market line is a graphical representation of the capital asset pricing model and applies to all securities whether they are efficient or not. Later in this lecture, we will talk about how we can identify overpriced and underpriced securities. At this stage, all I want to do is make sure that you recognize that this particular line is simply the capital asset pricing model. If you recall, the CAPM equation is as follows. Return on a given asset is equal to the risk-free rate plus the risk or the systematic risk, which is beta, times return on market minus risk-free rate. The intercept term is the risk-free rate, which is right here. The return is the y-axis. The x-axis is beta, which means that Rm minus Rf is the slope. So the slope of the security market line is the market risk premium, which is return on market minus risk-free rate. And to see why that's true, let's consider this point. Say this point represents the market return, so Rm. This point represents the risk of the market, which is 1. If you recall from our previous discussions, the beta for the market is 1. If this is 1, that means our x or change in x is 1. The change in y, which is this distance, is Rm minus Rf. So the slope is Rm minus Rf divided by 1, which is Rm minus Rf. So this is our security market line. If we have a high market risk premium, then the SML will be steeper. Now I want you to do example 7 from the curriculum. Many of my students ask about the difference between the CML and the SML, so I have put the two together on this slide. On the left you are looking at the CML, on the right you are looking at the security market line. The vertical axis is the same, expected return. The difference is over here, and this is one of the differences. Notice that with the CML we consider total risk, whereas with the SML we are considering only systematic risk. The slope of the CML is the Sharpe ratio. The slope of the SML is the market risk premium. Also, remember how we created the CML. We created the CML by considering the efficient market frontier, and then the efficient risky portfolio, which is the market portfolio. And then we connected this point to the market portfolio. In other words, the CML applies to efficient portfolios. SML, however, applies to any security, whether it is efficiently priced or not. Again, I want you to do the example before you look at the solution. Here is the data given. He has 3 assets in his portfolio: the risk-free asset with a weight of 0.1, return 5%, and beta is 0. This is not explicitly given, but we know that the risk of a risk-free asset is 0, so beta is 0. With the market portfolio, the weight is 40%, expected return is 10%. The beta is not explicitly given, but we know that the beta is 1 for the market portfolio. With the risky stock, the weight is 0.5 or 50%, the expected return is not given, and the beta is 2.5. What is the portfolio beta? To come up with a portfolio beta, you need to take the weighted average of the betas of each security. The weighted average would be 0.1 into 0 plus 0.4 into plus 0.5 into 2.5. When you do the maths, you should get 1.65. Then to compute the return of the portfolio, you can use CAPM and say return of the portfolio is equal to the risk-free return, which is 5%, plus beta 1.65 multiplied by the market risk premium, which is 10% minus 5% or 5%. You do the maths and you get 13.25%. Note that you can also come up with the return of the portfolio by figuring out the return of stock S using CAPM. Once you figure that return out, you can determine the expected return of the portfolio by taking a weighted average of those three numbers. When you follow that strategy, you should get the same answer. Now I want you to do example 8 from the curriculum. We now come to the applications of CAPM, and here we will focus on two major applications. Let's start with the estimate of expected return. We've in fact done this several times already. Given an asset's systematic risk or beta, the expected return can be calculated using the CAPM formula. Then if we want to estimate the price of an asset, we can discount future cash flows at the CAPM rate. The CAPM rate is also used in the capital budgeting process. We saw this in the cost of capital reading, and then we also used this in the capital budgeting reading in corporate finance. We have actually seen the CAPM formula before. If you have time, do example 9, where the data is given and it allows you to compute the cash flows for a project. You are also given the beta and other relevant data which allows you to compute CAPM or the CAPM rate, and then you use that rate on the cash flows to come up with a net present value. This is extremely straightforward, so I'm not doing calculations over here, but I would encourage you to go over the numbers in the curriculum.